So we have the FOMC decision. We got the FOMC decision live today. Will Powell cut or raise rates? I don't know. We'll see what he does. We will put this up right here. Again, he's almost certainly going to pause rates, but it's freaking time. Remember, we are not market experts. All right. Expectation is a pause. Yeah, so today's all right, so we will cover the full decision and announcement. All right, so again, we're going to keep interest rates where they have been for the last. Let's see how long the Fed funds rate has been this way. I was looking at so yeah, we've been at 5.5 and a quarter to 5.5%. If we look at the graph here for the rate decision, most people expecting a pause. 1.1% chance of a rate hike. Yeah, they've been this way since August. All right, the decision happens at 2 p.m. All right. $2.30. So we're putting this. We always get these same questions over and over again, so we're trying to put this up so you can see kind of everything here. We had the JOLTS report show up earlier. So there we go. That'll give you kind of a full breakdown. But yeah, you can see it's highly, highly expected to pause the federal funds rate at 525 to 550. 1.1% chance of a rate hike, but almost certainly going to pause rates. We did have the JOLTS report. If you look at the JOLTS numbers show up earlier, we had the non-farm employment change numbers. You know, yesterday we had Amazon earnings and a couple other big ones. We had Google, Microsoft earnings over the last few days, Amazon. When do we cut rates is the question. We're going to do a poll. The question is going to be, when do we cut rates? All right. Hey. Yeah, I got you guys. So I'm gonna put a timer up for the actual decision, which is in about 56 minutes or so, 55 and a half minutes or so. So we'll put a timer up. Here's the actual rate decision timer. And again, you can see we're almost certainly gonna pause rates. I'll put the Q up. Maybe the dollar index is relevant to put up. So here's the Dixie. I could also probably put the Fed funds graph up. Let me see. F funds. So I could put the. Let's put a money sign in front of it. No. Oh, here it is. Yeah, so again, here's a graph actually of federal funds rate over time. Interesting. You see, really, let's look at it since 2019 is the most relevant way to look at it, since it's all recent. But here's the federal funds rate, increase, decreases, all that stuff. Interesting. SPY very flat. Again, we told you guys we would get choppy behavior. We made some money earlier based off of this choppy behavior thesis. Yeah, we played the AMD dip, took profit on the bounce, and now we're just still sitting in a little piece of it. But it did bounce back nicely from where we bought it. You know, you can see our stats today. So here's my stats on Apex today. We're doing pretty well. We're up about 440 gross. If we're looking at net, you can see the total P&L right here. We're up about 360 on the day. We got about 77% accuracy rate. You can see our graph kind of choppy in the beginning, but that's all right. Doing pretty well there in that situation, so we'll see if we can keep that up. SPY testing the bottom of the range. Yeah, we're almost certainly not going to cut rates today. It's not even in the probabilities of a cut. Isn't even in the CME group probabilities. So again, I'm going to do a poll, but the question is really like, when do we cut rates, right? Let's do it. Today, not likely. What is it? June, July. Or here, I'm just gonna say, I'm not even gonna include today because today is so outside the realm of possibility. So I'm gonna put June, July. Here, let me. I'm gonna look at when they think we're gonna cut rates. Which again, if we pull this chart up, I think a lot of people are expecting like December. They're expecting a 25 basis point cut. November is pretty split down the middle. September was what it was previously, but now we're expecting here. So we're gonna have to use this poll to put like June, July. September, November. December plus. Or today. Not likely. That's what we're going to do. All right, so vote on the poll. You can see the federal funds rate graph. We can also look at like stuff like the Q. Here's the Q. We can put the Dixie up here. So vote on the poll. Most people think of December and beyond. I don't know who's voting for today. I think that's just what people want to happen. Like if you're in the mortgage or real estate industry, you might be desperate for that rate cut. But you know, unfortunately, inflation has been sticky. You know. Yeah, a cut today would be very bullish in my opinion, but I think it. I mean, I don't. While I think the market might respond bullish, I don't necessarily think it would be a good idea to cut rates today. Yeah, our FOMC meeting streams are growing, man. You know, we'll have 5, 6, 7,000 people here live when it drops, my guess is. If not when it drops during the press conference. At least I hope we can. I know we have before. Powell speaks at 2:30. We almost got 500 people here already. We started the stream, what, like 5 minutes ago, 10 minutes ago? House prices would skyrocket. Yeah, I mean, so much free lending, more, yeah. You know, again, you got to understand the logic. I explained this earlier. I usually explain this at least once a day. And it's just, for those that might be watching the stream, you know, we got about 500 people here. We'll have thousands and thousands of people when the Fed thing drops. But I'm going to go ahead and explain this once. I'll probably explain it at least a couple more times today, just so people understand, you know, economics. Okay, so what does this Fed decision do? It controls interest rates. The Fed's tools to combat issues in the economy are interest rate decisions, right? Interest rate decisions they can do also. Now they can directly influence interest rates, doing things like raising or cutting or pausing rates. So that's directly influencing these are short-term interest rates. The federal funds rate is short-term interest rates that banks charge each other to lend money overnight, but it trickles into long-term interest rates eventually. And so one of the Fed's tools is to directly influence interest rates and directly raise lower short-term rates, which eventually hits long-term rates. The other tools they have are, you know, relatively new tools that the Federal Reserve does. The Federal Reserve is kind of like the bank that creates policies and supports the other regional banks in each, you know, in around the country. And so, again, they can directly influence rates and directly change, raise, lower, pause rates. Today we're expecting a pause. Or they could do stuff like QE and QT, which is quantitative easing and quantitative tightening. They both have to do with the Fed's balance sheet. So QE expands the Fed's balance sheet basically by them coming through and buying a bunch of bonds. QT, it does the opposite. It's not directly selling bonds. It's usually, unless it's direct QT, it's usually passive QT, which means they're letting their current bonds mature and run off, you know, because eventually the bonds are going to mature. If it's a 1-year bond, it's going to mature in a year. If it's a 10-year bond, it's going to mature in 10 years, so forth and so on. So eventually they'll run off the balance sheet in that regard, but it has to do with providing liquidity. So with QE, with them buying up a bunch of bonds, interest rates can go down because they know the Fed's going to buy up a bunch of stuff. It's going to inject liquidity into these economies and these markets. And so it's going to allow banks to lower interest rates to consumers. And the reason the Fed would do QE or cut rates, they're both kind of targeting the same thing, is so that people spend more. If the economy's at risk for a recession like we were in 2020 when nobody was working, you know, all this stuff was happening, the Fed stepped in and brought interest rates down to almost zero. And they did lower them relative to where they were. You can see the federal funds graph here. So this is short-term interest rates that the Fed is controlling. You can see prior in 2019, they were at this level. after 2020, they brought them down to almost zero, right? And again, the reason they do this is because if people are spending less money on mortgages or less money in auto financing, they're going to have more money to spend on other things, and thus it stimulates spending in a positive way. And so the Fed will do that if the economy is at risk for a recession, depression, stuff like that. But one of the consequences of this behavior by the Fed, either it's QE or it's rate cuts, one of the consequences is inflation, because people spend more and businesses raise prices to compensate for it. So one of the problems with that is inflation. And that's what we got in 2020. They reduced the interest rates down. People started spending more. They sent out stimulus checks to try to save the economy. And one of the consequences was inflation. Inflation spiked a few years later to almost 9%. And so then the Fed has to pivot to the other end where they they do rate hikes. They raise the federal funds rate. They raise short-term interest rates. Or they can do, again, QT, which is they basically stop providing that liquidity to the bond market and banks keep interest rates high. And that's kind of what we're currently in. That's called hawkish Fed that's trying to keep interest rates high. A dovish Fed is trying to keep interest rates low and add spending to the economy, add more spending to the economy by doing so. So that's basically what happens. And again, right now we're in a period of too much spending, right? We're not really at recession or depression risks. We're more so in a period of too much spending, where we have too much spending. The labor market's been too strong almost over the last 4 years, 3 years, since interest rates were so low and people started spending so much. And so the Fed's trying to keep interest rates high, which is if you look at mortgage rates as an example, they're 7, 8, over 8% in some places. And again, real estate mortgage people are struggling because it's really hard to sell homes and mortgages, specifically if interest rates are really, really high. But, it's kind of like picking up pennies in front of a train track, though, is the easiest kind of analogy I can use, in that you keep interest rates high. One of the consequences is that people stop spending. People stop spending can be bad if it happens too much. And so it's kind of this balancing act the Fed's always trying to play, where they want a strong economy, but not so strong to where inflation gets freaking crazy and out of control like it did after 2021 or so. And if you look at inflation, if you look at CPI, it's kind of the same thing. Right, but here's the federal funds graph. We've been pausing interest rates since August of last year. So we've been keeping interest rates steady since August of last year. And the question is, when does the Fed start bringing interest rates down? When do they end QT, which is what they've been talking about recently? And we'll probably hear it after the fact when they start ending QT, which is, again, quantitative tightening. But, again, interest rates have been paused since July of last year. Now, I don't think we should cut rates. I think cutting rates too soon, the problem with inflation is that when it starts to snowball, it can go really, really quickly. It can spike really, really quickly. Very rarely does inflation ever actually go down. It slows down. And so the Fed's target of slowing down inflation is to only a 2% increase on the year. And so in that regard, you don't want inflation to spike more. Prices very rarely go down. So once prices go up, it's hard to get them to go back down. And so again, if you look at prices right now, while inflation's only at 3% right now, which is not conventionally crazy high, prices have spiked so much over the last 4 years that people still think prices are so high, prices are so high. The unfortunate part about it is it's very hard to get them to go back down. Hold on one second. Hey, I'm right in the middle of my stream. I mean, I can. All right, sorry, my wife's calling me. But yeah, so that's kind of where we are now. I don't think the Fed, again, you talk to a lot of, and I'm a real estate agent as well. I don't really sell houses. It's more for investment purposes. I don't really care about selling houses that much. Haven't sold a house in years, to be honest, because I got other stuff to do. But if you talk to them, which I know a lot of people in real estate, they are not happy right now. The conventional appeal of real estate is that, you can buy a house and mortgage a home and own the home and pay less than you would in rent. But right now, that's not necessarily true. That's not really how it is right now. Right now, you're going to spend way more money trying to mortgage a house than you are in rent. And so what's the consequence of all that? People stop buying as many houses. Commercial's definitely struggling, but it's been struggling for years before any of this stuff really hit, mostly from technology and tech growth and big business, but yeah. Yeah, but I mean, Jim, it sounds like you're using the metric of 4 years ago. Yes, prices are up, but again, like I said, prices very rarely go back down. You know, we're talking on the year, and so, you know, I don't know. I think prices are certainly high relative to 5 years ago, but again, prices rarely go down. Inflation very rarely goes down. The best we can try to do is slow it down to 2%. So. Fed will eventually cave into political influence, even though they shouldn't. Small cut at least 2 meetings before November makes them look impartial. 0.25 in June, July makes the most sense. Well, originally I was thinking June, but I don't think that's going to happen anymore. I think it's going to be a little bit later. But, yeah, I'm reading back up in the comments now. Most likely pause is what we're going to get, so the Fed's probably not going to move interest rates today. They're going to keep them the same. And the Fed is really balanced. Again, every major Fed meeting that we cover, and we cover every one, you always got some people that are betting on something that's just super unlikely. Like, you know, and again, they're almost always wrong, yet some, for whatever reason, I don't know if it's confirmation bias, where they want interest rates to go down, and so they want the Fed to cut rates. And so they overestimate the likelihood that it's going to happen. But again, we're almost certainly going to pause rates today. Now, you could try to gauge whatever outcome you want from the market, but we're almost certainly going to pause rates today. And I guess I could be wrong, but one thing with the U.S. Federal Reserve, and specifically Jerome Powell, is that he tries to stay balanced. He's usually not going to shock people. And so that's one thing to understand. Again, it could happen. Anything could happen, but not super likely. But who knows, man? Again, if we cut rates now, I think it's bad long term, but it might help markets short term. So we'll see. The real question is, what does Powell say during the press conference? Which, again, whether he's going to be hawkish, meaning he wants sustained high interest rates, or whether he's going to be dovish, which means he wants to lower interest rates, right? Technically, it's defined, I believe, as like hawkish is pushing for a contractive monetary policy, meaning he wants to keep interest rates high, discourage spending, push the economy down so that inflation goes down. And if that's the priority, again, he'll keep interest rates high. If the priority is to help the economies and contribute to more spending, he's going to be what's called dovish, again, which means he wants to keep interest rates low or bring interest rates down. They're not low right now. They're still pretty high. Again, if you look at one of the metrics I looked at is the NBA 30-year mortgage rate graph. Like, look at this graph here. And again, you can kind of see it run alongside. You can kind of see it running alongside the Fed funds rate. Here's the Fed funds rate, and then here's mortgages. Let me do a 5-year chart. Yeah. So like, here's the same 5-year chart on both of these, right? You can kind of see how similar they look. It's not an exact science by the Fed, but again, you can kind of see how similar these two look, right? So again, 2019. Fed funds rate was at about 2.25 right here in 2019. NBA mortgage rates were at about 4.5% in 2019. Once 2020 happened, the Fed brought them all the way down. The Fed brought the federal funds rate down to almost zero. Here's zero, right? So the Fed brought it down to basically zero. And again, you can kind of see in 2020, eventually it's a lagging effect, right? But eventually you can see mortgage rates come all the way down to 2.9%. At the end of 2020, right here, you know, and again, we paused rates, so again, they fluctuated on the pausing action, but then inflation started to spike, right? So then inflation got up to like high percentages. I think it topped at like 9%, and so what does the Fed do? The Fed starts to do their rate hikes, which is what we experienced from 2022 to 2023 plus, and what happens to mortgage rates? They start to climb on higher, you know. And then we've been pausing, so we haven't been raising interest rates, and so interest rates have dipped a little bit, but again, they're basically neutral to signal that, right? So again, I hope that all makes sense. That's the way you track it. It's not a perfect science, but that's economics and the Fed. I hope it makes sense. During this whole period of time, yeah, look at the SPY, very choppy, very choppy. Hey John, if the Fed keeps the rate pause the same, is that a hawkish stance? Please and thank you. Yes and no. It's hawkish because interest rates are already high, and so pausing when interest rates are high would probably still be seen as like a contraction mindset of the economy. Like it's kind of like if you bring the temperature up to 105 degrees Fahrenheit, for all my U.S. people, Fahrenheit, English. Sorry, England. No, we're not doing Celsius. But yeah, 100. Anyways, back to the point. ADHD. If we brought that temperature up to 105, right? That's like saying, is it still hot? Yeah, it's still hot. It's not. It doesn't mean we're gonna keep raising it. Eventually, keeping it that high will break things if we keep it too high. So eventually, the Fed's gonna start trying to bring it back down to cooler levels, which is more dovish levels. But yeah, I would still argue it's hawkish. What's going to matter more than any of this is what Powell says during the press conference. Like Powell, like we already know we're almost certainly going to pause rates today again. The real question is, what does Jerome say during the press conference? Listen to recession expectations, listen to rate cut expectations, listen to rate hike expectation. If Powell comes along and says, hey, plan has changed, we might raise rates because of rising inflationary pressure, that's not going to be a good necessarily, that's not going to be a good thing necessarily. That's going to make markets panic most likely. And so it'll be interesting to see what he says. We're not going to cut rates today. People saying all relevant inflation metrics have gone up with the Fed's response. Okay, so let's look at a CPI graph if we can here. Let me see. I know. Yeah, so here's consumer price index 12-month change, right? So here's CPI inflation. The Fed uses PCE, but we're gonna use CPI just as this example, right? So again, 2020. Again, interest rates fell, inflation spiked. Fed started raising rates, trying to combat it. This pushed inflation back down. And now since June of last year, so we've been mostly at 3.5, 3.2%. If you want to look at a more accurate gauge of inflation, you can look at core PCE inflation graph. Let's see if we can find one. All right, so here's the core PCE graph, right? Last time we showed March, 2.8%. As this is the personal consumption expenditure. The core one excludes food and energy prices, which are a little bit more volatile prices. That's why when you hear people say, oh, inflation's still bad, usually they're talking about food, energy, So, but outside of those things, you can kind of see inflation has been going down since the Fed has been keeping interest rates high, and we've kind of stabilized month to month here. PCE dropped last week at 2.8% for March. According to you, if rates are increased, how much percent will market fall? I don't know, bro. If Jerome Powell walks outside and stubs his toe on his left foot, at 5:30 in the afternoon, which way is the S&P 500 going to close tomorrow? I don't freaking know, bro. We're talking about the economy, brother. We're not talking about the stock market. The stock market's been running regardless of any of this stuff because it's mostly AI and NVIDIA and tech. So during this whole period of time with all these up and down graphs that I've been showing you, the stock market has mostly been running up really, really high from technology and AI. And so sometimes they're different markets. 3% is the new 2%. 3% is not really that bad, man. Again, everybody acting like 3% is crazy. Again, if we look at the CPI graph, right? Like, we're right around where we were. Like, here's 2004, right? Here's 2004. 2004, we hovered between 1.7% and up to 2010 or 2008, which and so again, we hovered anywhere between 2.5 to, or from 1.7 at the lows all the way up to 4.5. And so again, 3.5 is within this range. Like, if we're looking at normal inflationary pressure, again, with that in mind though, right? Like, you can see very rarely do prices ever actually go down. Like, look, maybe this one was a little bit, we went down a little bit there, but very, very rarely do prices ever actually go down. We can only hope to slow them down. And that's the rate that we're tracking with inflation. How does this affect LeBron James's legacy? I mean, listen, I love Michael Jordan. I grew up in the 90s, okay? I went and saw Space Jam in theaters. All right, with that said, LeBron, his record speaks for itself. I think he's solid. He's probably the greatest, basketball player. As much as I hate to admit it, because I'm such, like, I grew up in the 90s. I really wish it was Jordan. But objectively, it's LeBron, I think. Anyways, we got 30 minutes, chat. 30 minutes. Sometimes, in spite of knowing the rates change, why do markets immediately move massively? I don't know. It's just an economic report. I did wear Jinkos. But is he top 3 of all time? Definitely top 3. Yeah, it's gonna stay between 5.25 to 5.5 basis points, or 5.25. Yeah. How could you say LeBron is better than Jordan? I think it's very close. Jordan has more championships. LeBron has done it for more teams, right? Now, I think there's a really good argument for, like, LeBron. LeBron has done it for more teams and been around different teams and still done it. Jordan mostly had that really freaking good Bulls team in the 90s. And so I think it's arguable. And again, I'm going to say Jordan is the GOAT just because I grew up in the 90s and he's won more championships. But, like, I think it's more nuanced than that. I think, but it's all good. I didn't have frost tips, bro. I had, like, shaggy hair, Like, you want to see me? This is me in, like, 2007, But this is what I looked like in the 90s. I'll have to find it. I don't know what happened to the pic. I have to keep scrolling up to find it. It's somewhere, dude. I got an old picture of myself. I'll have to keep scrolling to find it. Alright, chat. Again, look at the SPY bounce all the way back up to 501 plus. All right, chat, you ready for the FOMC meeting? Oh, wait, I got a picture. It's on Twitter. I could just find it on Twitter. Yeah. All right. All right, so here's me in like, this is like 2007. It's 2007 John right here. Look at that hair. Look at that hat. What a, you know, but again, if you want to know what I look like in the 90s. All right, let me find this. My hair wasn't blue, but I had this haircut. You know, like the Murders by Number kid? I had like the bowl cut, but it was parted straight down the middle like this. It wasn't emo though. This was like before emo was a thing. This was more like, you know, like that was me. You know what I mean? That was me. No, that's me. In the 90s, right? Much shorter version of me. I didn't hit my growth spurt until I was like 5th grade, you know? Probably Franny, that's probably true. Yeah, cut's not coming. You know, cut's not coming. That's John Cena. Hey. You look a lot tougher now. Oh, to be fair, I probably am a lot tougher. Like, I train jiu-jitsu now. You know, I would beat my old self up. You know, I'm a little bit stronger too now. I was probably 130 pounds in that picture. You know, give or take. I don't know how, you know. Yeah, we're not going to raise rates. We're certainly not going to raise rates. I don't think we're going to cut rates either. I think we're going to, I mean, listen, certainty is not something I usually say. We're almost certainly not going to raise rates. Although, I guess I would, what do you think is more likely, chat? A rate hike or a rate cut? I'm going to go with a rate hike. I think I could see the Fed raising rates under very obscure scenarios, raise rates, and then do like a 50 basis point cut, you know, 2 meetings later or something this year. I highly unlikely, but I don't know. Do you lift, bro? Sometimes, yeah. Why did you block your finger? Because it's a family-friendly stream, bro. Okay. You know. All right, spy at 501s. 501s. All right, chat. We got 25 minutes left. I personally am good at no-gi. Although I do train gi as well. But I'm much better at no-gi, to be honest. No-gi, I feel like I'm a problem. To any belt under purple belt, I'm a problem. You know? If I'm in a gi, a blue belt will destroy me, you know? Alright, chat. You guys ready? Yeah, look, if you want to know. Typed in murder by numbers hair. See if it pops up. I had this kid's haircut, although it wasn't this long ever. And it was much curlier. 6th grade, this was me, basically. You know, that's me in 6th grade, basically. Essentially, that was me in 6th grade, with curly hair, you know. I put gel in it. I thought I was cool. I was cool, but not as cool as I thought I was. Anyways, we got 20 plus minutes left until the Fed decision, chat. Hey, thank you, Bernardo. Rates will stay the same. It's at 98.7% chance. Yeah. If you can do gi, you can do no gi. Yeah, for sure. But if you do no gi, it doesn't mean you can do gi though. That's the difference. All right, chat. Will we crash? crash if they raise or cut? No, I think if we cut, market's probably gonna run. If we raise rates, market's gonna panic most likely. You know, so if we raise, market's gonna panic probably. You know. All right, chat. Again, SPY up to 501.13s, 501.13s. What tie will he wear? I don't know. Why do 22% of people think a cut is coming? Probably because they're desperate for it to happen. You know, if you really want rates to go down for whatever reason, then you might just be really biased in that way. Will the interest rates be bullish or bearish? What's the play ahead of Nvidia earnings? I don't know, man. All right, guys. Again, 20 minutes left until the FOMC decision. The big decision is going to be, what Powell says during the actual press conference. And again, we're going to stream it live. We're going to talk about it. We're going to break it down. We're going to watch markets as it happens. Explain what's going on here, chat. So again, remember, the data drops in 20 minutes here, 20 minutes. There's the Q at 422s. SPY, very choppy, very flat. We told you guys we'd be flat today. Honestly, yeah, you never needed a degree for IT work, T-Dragon. Even programmers don't need to go to college anymore. They go to boot camps. And again, the big thing about programming is that if you know how to do it, you know how to do it. If you can pass the test the tech company gives you and show them that you know how to code, they don't care what school you go to, brother. They never have, right? I mean, the difference, though, is that most people can't code, and so it doesn't really matter either way. But IT is kind of the same thing. If you know how to do penetration testing, or if you know how to build servers or whatever it is, they don't care what school you went to for the most part, outside of like the most prestigious of jobs. It just depends on what it is. You know, again, like I can program like React Native, JavaScript, a little bit of Python, and so you know it just depends on whether you know how to code or not. I mean, it wasn't fake news, but damn, dude, Tilray did come all the way back down, bro. Crazy. So did the Fed really change their mind on the cannabis reclassification? I don't know. I just read that DEA, according to Marijuana Moment, agrees to reschedule cannabis. Politicians are so full of crap, dude. Like, okay, how many times have you heard, oh, we're committed to taking cannabis and making it legal, and then when they get power, they never freaking do it, bro. None of them do. None of them ever really do it, you know? I'd respect them a lot more if they were just like, nah. Like, I'm not gonna do it. You know, I'd respect it a lot more. But to posture like you're gonna do it just to get votes and then just not even do it, and then they're getting so much money from pharmaceutical companies, like lobbying against cannabis legalization is what it is. So who knows when it'll actually happen? But the thing descheduling does is it makes banking and loans allowed on cannabis products, which will grow the industry. But yeah. The only reason the Fed would cut rates if the economy was getting weaker. Yeah. .3% chance of a cut. That's embarrassing if you think a cut is coming. Yeah, it's I'm front end almost certainly. I'm not a good back end developer. I don't want to do MySQL and all that stuff. I'm not, I'm not about that. I'd rather just play with the DOM and mess with stuff. Meta. Bro, what is PAMP, dude? I keep hearing PAMP. I don't even know what it means. Meta's running. Whoa, dude, I didn't even know. Look at Meta today. Hey, you'd love to see it. Who knew, man? I'm in it right now. I didn't even know Meta was running. I'm in at 412. AMD, we'll see if it bounces back. 15 minutes chat. How do you like your steaks? Rare. Bloody. Rare plus, maybe, A little bit less cooked than medium rare. Yeah, I mean, I don't think we can afford to cut rates either. I think it could cause inflation to really get bad. Thoughts on Starbucks at $73 a share? I think it's got coffee on lock. What's the PE ratio of Starbucks? Let me see. All right, guys. 15 minutes. PE ratio is 23. I think Starbucks is probably pretty cheap where it's at. I think it'll probably bounce over the next couple months. But I might be wrong. I might be wildly wrong. Do not copy me. I'm not an investment professional. I'm not liable if you lose. I have no idea what I'm talking about, and I might be wildly wrong about anything and everything I say. If you lose because you listen to me, it's your fault, not mine. Top 3 worst traders in the world ever. How about Taiwan Semiconductors? Volatile. A little bit too volatile for me, but hey, I'm for it. Most people are still so bullish. Well, bullish doesn't have anything to do with rates. Mika. Bullish doesn't have anything to do with rates. Yeah, 2:30 is definitely more important than 2. We're almost certainly going to just announce a pause at 2 p.m. All right, chat. Hey, we got time. Q. All right. Yeah, so again, AMD PE ratio is not the real PE ratio. So the difference between AMD, right? Like I hear a lot of people saying that AMD PE ratio is 300. I see a lot of sites saying it as well. It has to do with the Xilinx merger, right? So the way you calculate the PE ratio that I use and that most people use is that you add up the last 4 quarters EPS, and then you divide that by the share price, right? You take the share price, you divide it by whatever that number is. If you do that with AMD, the PE ratio is like 55, right? It has to do with GAAP and non-GAAP, right? With GAAP, you're going to have the Xilinx merger, and so there's going to be a big difference because of amortization of acquisitions, specifically, again, Xilinx. The expense from that amortization is an expense for tax purposes, but it's not an actual expense that they're gonna have to pay, and the benefit, yeah. So again, that's why there's a difference between 300 that you see on sites for AMD and the actual PE ratio behind it all. If you look at just like how much they're making on EPS versus everything else, so yeah. It has to do with GAAP. GAAP stands for generally accepted accounting principles, right? But again, what it has to do with is a merger they recently got in that's artificially inflating their PE ratio super high. So I hope that makes sense. Not an argument for weakness in AMD is the point. All right, chat. 9 minutes. We got 2,000 people here live. Do you think the dollar will be stronger today? It depends on what this is going to show up as. All right, chat. Look at AMD still bouncing back up. All right, remember, during the actual FOMC meeting, chat, I'm going to put this in sub-only mode here so we can try to gain some of these subscribers from the Fed meeting. All right, so we got the big FOMC meeting today. Again, we got 8 minutes left. 8 minutes. SPY is very, very flat. Still over the 200 EMA. Almost everybody's expecting a pause in rates today. It's almost certain that we're not going to raise rates. We're not going to lower rates either. It's almost certain that we're going to pause rates. Powell pump, because, yeah. US dollar will go low. It'll depend. Do you listen to Future? None of his new stuff. Some of his old stuff. I'm old, so if I do listen to Future, it's from like 10 years ago, Future. Q at 422.20s. SPY at 501s. Seven minutes, chat. 7 minutes. In your opinion, is a pause positive or negative? It's neither. It's neutral. It's flat. There's no. It's almost certain what's gonna happen. It's not really bullish, bearish, hawkish. I guess I'd call it hawkish because we're keeping interest rates high. We're not cutting them back down to bring interest rates down. But and again, if you guys want to understand this, I'm going to break this down one more time. I broke it down earlier. I think now is probably the best time to break it down again. which is like, listen, the reason the Federal Reserve raises or lowers the federal funds rate is short-term interest rate. It influences long-term interest rates like auto financing, like mortgages, and depending on where the economy is will influence their decision. If the economy is at risk for recessions, depressions, too little people working, too little people spending, the Fed will step in and they'll bring interest rates down. And so by bringing interest rates down, it allows people to spend more money and thus stimulate the economy, because if you have less money to spend in a mortgage or whatever, you're going to have more money to spend on other stuff. The opposite is true if inflation is really bad. If inflation is really bad, that typically means too many people are working, too many people are spending, and in that regard, the Fed wants to bring interest rates higher to discourage that spending, because if you got less money to spend because of high interest rates on auto loans or mortgages, you're gonna stop spending as much, and thus it will slow down an economy that's too hot. We've been raising rates since last year. We've been pausing rates since last year, and prior to that, inflation had spiked to almost 9%, so the Fed was really aggressive in raising rates. All of this started in 2020 when we brought interest rates down to almost zero to save the economy from the pandemic. And so now we're here where inflation spiked from 2020 and the really low interest rates that we got from it. And now we're here trying to bring interest rates, now we have paused interest rates at their peak when they're really, really high, and we haven't raised them anymore. The question is, when do we start cutting rates? And again, the problem with cutting rates too early is that it will make inflation worse. It'll spike inflation pressures. It'll make inflation problems much, much worse. And again, that's just not what we want. That's not what we want. And so again, we got to be really careful on when we decide to start cutting rates. And I think right now is way too early. I don't think we should cut rates until December plus now. Because of inflation spikes that we've seen in the inflation data in both CPI and PCE over the last 2 months, 3 months. So again, the problem with inflation is that when it starts to spike, it can really snowball and get worse really, really, really fast. So yeah, we're probably not going to cut rates. We're almost certainly going to pause rates in about 4 minutes, and then we're going to cover the full press conference. I'm out of breath now. I'm trying to cover it before the data drops. The meeting's at 2:30. Now the market will react. We don't know how it's going to react. We'll put the Q and the SPY up right here. Very flat days. We thought we might get that. 4 minutes. All right, chat. All right, guys, SQ at 6650s. SPY at 501s. Yeah, again, we're not going to cut rates. A surprise hike would probably cause a panic in markets realistically, but hey, anything can happen. Commentary is the real question. Like, what does the commentary show? And again, we're going to stream the entire thing live as it happens, as we always do. We're going to stream the entire conference live right here on YouTube. So stick around, chat. We do this live every day. We cover a lot of this stuff live. All right, chat, we got 2 minutes. 2 minutes. Hit the live button next to the play button. We got over 3,000 people here watching right now. Hit the subscribe button next to the play button. Make sure you're fully caught up on stream. We got 2 minutes. We're going to cover the full press conference as well, so stick around. Don't go anywhere. Again, remember, what happens in 2 minutes is not the biggest thing that's happening today. All right? We're almost certainly going to pause outside of like a crazy, unexpected rate hike, I think. We're not going to... That's not the biggest thing. What matters most is in 30 minutes. And again, we're going to stream that fully live, completely live. You'll be able to watch it completely live on this live stream. So stick around. We got a minute and a half left until the actual announcement for what their decision is going to be, which again is almost certainly a pause. Thank you, Roman, my guy. Thanks so much, brother. I appreciate the $10. And yeah, we'll see what happens, chat. We'll see what happens. We got about a minute left or so. Yeah, you're going to see crazier moves when Powell speaks, especially if he says something like we could hit a recession, if he says something like no cuts this year, if he says something like we're going to get multiple cuts this year, if he says something like we don't think we're going to hit the 2% inflation target until 2028 or something like that, expect downward pressure. Those are kind of buzzwords you want to pay attention to. Recession, rate cuts, rate hikes, inflation targets. Those are all things you want to pay attention to, chat. We got less than a minute here, less than a minute. Yeah, the job market has been strong. It's kind of what the inflation has been spiking on. All right, I'm going to put this song up. I like this song. This song was good. All right, so I'm going to put this song up again. 30 seconds, chat. Yeah, what color tie will Jerome Powell have on? 20 seconds. All right, let me go to the FOMC website here. All right, 5 seconds. All right, here we go. No reactions yet. Waiting. Here, chat, rating. Markets spike it up, down. Looks like a pause, personally. All right, so yeah, federal, they paused rates. They kept them the same. Federal funds rate is paused. Again, we told you guys we were going to pause. We told you guys we weren't going to raise rates. We told you guys we weren't going to lower rates. We are pausing rates like we told you guys. Market hasn't reacted. The bigger thing here, chat, again, the bigger thing here, chat, is going to be Jerome Powell's press conference, which we will stream live as it happens. Again, here, as expected, a pause as expected. As expected, full FOMC meeting streamed live at 2:30. Again, we were streaming the entire meeting live here at 2:30. Again, the Fed leaves rate unchanged as expected. They says will slow decline of balance sheet by cutting Treasury redemption cap to $25 billion per month from $60 billion from June 1st. All right. All right, so again, the full press conference is at 2:30, so stick around. All right, guys, be ready here. Again, chat, FOMC is pausing rates. And it was a unanimous decision. All right, so a unanimous decision to pause rates. All right, so again, we are going to switch this. Federal Reserve press conference. Again, be ready, chat. We're going to stream it all live in about... We'll put the timer up. And again, market has basically unchanged. It is up a little bit. I guess maybe some people thought we were going to raise rates today. Super unlikely. We're going to start this in about 23 and a half minutes here, chat. Or 26 and a half minutes is what we'll do. Yeah. All right, 27 minutes, chat, 27 minutes. Stick around here. Guys, again, we are going to stream the entire press conference live as it happens. Yeah, we'll see if the, slowing of QT. Yeah, so again, they say they will slow the decline of the balance sheet by cutting Treasury redemption cap to $25 billion per month from $60 billion from June. So yeah. They've been slow in QT for the last couple meetings. Is it dovish? It's flat. So it's flat. It's as I told you guys we were gonna do this. So yeah, it's flat. At 2:30 p.m. Eastern Standard Time. We're gonna have the full press conference watch live here, chat. Market's starting to spike on this news here. Again, ending QT is good. So, like, again, to put this into perspective, right? We're not ending it. We're slowing. Slowing QT down is good. All right, the reason the Fed does quantitative tightening is, again, what this really is they sell bonds, reduce their balance sheet. By reducing their balance sheet and letting... They don't sell bonds directly. Usually they just let their current holdings mature and run off. But by doing so, this keeps interest rates high. It takes liquidity away from those markets and keeps interest rates high. And so them slowing down QT is an optimistic sign towards interest rates coming down, right? That might be why the market is spiking up here, is because, again, it is an optimistic sign and towards interest rates. If you want to read the full FOMC decision here, we'll break it down right here in chat here. So again, here's the statement. Recent indicators suggest that economy has continued to expand at a solid pace. Job gains have remained strong. The unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. In recent months, there's been a lack of further progress towards the committee's 2% inflation objective. Basically, inflation hasn't gone down like they wanted to. The committee seeks to achieve the maximum employment and inflation at the rate of 2% over the long run. They judge the risk to achieving its employment and inflation goals have moved toward better balance over the past year. Economic outlook is uncertain, and the committee remains highly attentive to inflation risks. In support of its goals, they are keeping the federal funds rate the same. They don't expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. In addition, the committee will continue reducing QT, basically, in addressing the appropriate stance of monetary policy. The committee will continue to monitor implications of incoming information from economic outlook. That's basically what they're saying, right? So again, let's look at this again. Job gains strong, employment low, unemployment low, inflation eased over the past year but stays high. In recent months, there hasn't been much progress towards inflation. And so again, to do this, they're pausing rates and they're also slowing QT down to combat high interest rates. But yeah. Again, this was neutral. But yeah, that's basically what we're in right now. And again, the press conference starts, again, 2:30 chat, 2:30 chat. Stick around. Again, we're going to stream the full thing live in its entirety. We only have about 23 minutes left. Where do you see it postponed? What's QT quantitative tightening? It's essentially the Fed reducing their balance sheet, taking liquidity away from the bonds market so that banks keep interest rates high. It's super jargony and nuanced, but that's basically what it is. Basically, the Fed trying to keep interest rates high. They can either raise the federal funds rate, which is raising short-term interest rates directly, or they can influence what markets do in that regard by taking liquidity away from markets, keeping interest rates high. Hope that makes sense. All right, chat. Hey, we got 22 minutes. 22 minutes left. Market's starting to turn back down. Yeah, I see somebody say that they're delaying the reclassification of cannabis. I don't see that anywhere. I see cannabis stocks have kind of turned around, though. Specifically, CGC. Actually, CGC's up again today. Or no, it's down. Man, what a whirlwind. Yeah, hit that like button, chat. Again, SPY's starting to spike up. SPY is mostly flat on the day. It hasn't really gone anywhere. It's mostly sideways. It's at 502s. I'll be right back, guys. Listen, I'll be right back in less than 30 seconds. If I take longer than 30 seconds, you can call me dummy for the rest of the day. All right? So I got to be back before... I'll start at 20:30 on the timer. 20:30 on the timer. I got to be back before 20 even. All right, if I don't, you can call me dummy for the rest of the day today, chat. Again, the press conference is coming soon. Be ready. Press conference is coming soon. Take my headphones off. All right, guys, 30 seconds. You can call me dummy if I'm not beating it. All right. All right, I'm back. All right. Yeah, I didn't have to go to the bathroom. I had to go do something else. Like, my wife called me earlier and needed me to do something. All right, chat. Dude, I didn't go to the bathroom at all, bro. Y'all, you know, listen. I don't think I could ever go to the bathroom that fast. You know? That'd be kind of, like, not hygienic. You know what I mean? Alright, chat, here we go. Be ready here. Be ready, chat. $18 minutes. Again, 18 minutes. We got the FOMC meeting starting soon here. So be ready. Hopefully they say good things, right? The big thing today, again, chat, the big thing today, I'm going to break down the macroeconomic interest rate inflation landscape. Stick around leading into this Federal Reserve meeting. Okay, so here's short-term interest rates. Again, 2020 happened. I'm going to try to do this as exciting as possible because it's really boring. It's really jargony. It's really complicated and nuanced. So we're going to break it down and we're going to try to make it as exciting as we can. Okay, boom. 2020 happened. Disaster strikes the U.S. economy. Okay? The Fed says, oh no, the economy's at risk for a recession and depression. Too little people are working. What do? We bring interest rates down. This allows people to spend more money and boom, the economy is saved. Let's drop rates. So again, you can see interest rates were hanging out. The Fed stepped in, said, not today. We're going to bring them really, really low. We bring the federal funds rate down to almost zero. Can y'all see this? Y'all can't. I am slacking here. We bring interest rates down to almost zero right here. This allowed people to spend more, and the accompanying problem of people spending more is inflation spiking. If you look at CPI inflation data over time, you can kind of see in 2020 what happened to inflation. It went from 0.1% all the way up to 9.1% in June of 2022. And so by bringing interest rates down, it allowed people to spend more and the economy was saved to a certain extent. But the problem, the accompanying problem from that is inflation. Inflation spiked, people spent more, businesses raised prices because they can, because people are spending so much. Rolex prices doubled. Louis Vuitton prices went up. All the prices for food went up. And yeah, we hit 9%. And so the Fed steps in and they say, hey, we can't keep interest rates this low. Let's raise the federal funds rate. Let's raise short-term interest rates. They do this. And what follows that is damage to inflation. If you look at this now, you see inflation started to go back down after they raised interest rates. They also started a QT program. Where they started reducing their balance sheet, taking liquidity away from markets, bringing interest rates down. These things did help inflation, But as you read in the report, inflation has been kind of sticky lately since last year. We've basically been between 3% on CPI inflation up to 3.7% right now. Last month we showed 3.5%. If we look at PCE, which is core PCE is the most important one. But if we look at PCE data, and again, you can see this same graph in mortgages. Okay, you can see the same graph. Here's mortgage rates. All right. Prior to 2020, they were at like 4.5%. The Fed did QE, which is they bought up a bunch of bonds, expanded the balance sheet, gave liquidity to markets. This brought interest rates down to 2.9% at the end of 2020. Again, inflation spiked, and so the Fed stepped in and started raising the federal funds rate. So what happens to these rates is they start to spike as well. Now we got mortgage rates sitting at 7.5% or wherever they're at right now. And so again, right now, the Fed is in a period where we've raised rates aggressively. Here, you can see we've raised rates aggressively up until August. And now we've been pausing interest rates. And again, this is another pause here. This is a federal funds graph. This is another pause that we did today. And so again, another pause. We kept interest rates the same. And again, but we are starting to slow the QT program down, right? So that could contribute to potentially lower interest rates in the future. But without directly cutting rates, because again, inflation can get rough. And so, that's kind of why they're probably doing it that way. Anyways, chat, we got 15 minutes. Compare the 2-year to the Fed funds rate, 2-year bonds. Yeah, but I mean, again, that makes sense because that's what they're doing with all this stuff. They will hike again. I don't know. Well, it depends on what Powell says. Powell saying things is going to influence this the most, right? So what Powell says will cause the greatest influence over markets right now. I told you guys we were going to pause. I told you guys we were going to pause. Yeah, I told you guys we were going to pause. Again, this is kind of how it goes. Very rarely does Jerome Powell ever shock markets. He's just not about to really shock markets like that. Instead, he's going to do what's balanced and expected usually. Sometimes you'll see countries overseas or like the Bank of England sometimes will do a surprise rate hike or a surprise rate cut. Our government is less likely to do that. Now, the Federal Reserve is not technically a government entity, but they might as well be. So, yeah, that's basically what we got going on right now. Again, we paused interest rates, which is what was widely expected. We told you guys we would, and now we're sitting here waiting for the press conference in about 12 minutes or so. And again, we'll see what happens. Be ready, chat. Does the rate decision of the press conference move markets more? Well, it depends on what happens. If we're as expected, which again was a pause today, the press conference moves markets more because that's where Jerome Powell is going to give outlook. It's kind of like guidance for the economy. If we shock the markets, like in that situation, right? So if we're expecting a pause and the Federal Reserve raises rates shockingly, that's going to move markets probably more than the press conference will because it's so far outside of expectations and it's a shock, a jolt to the system. But outside of a shock like that, the press conference is going to move the market more because that's where Powell, the Federal Reserve Chairman, is going to give his economic outlook for the future. What he thinks is going to happen, recession expectations, inflation expectations, rate cut, rate hike expectations, rate expectations in general. And again, what all that means for the economy, markets, where jobs are at. These are all buzzwords, again, that you want to listen to. You want to see whether whether the Fed's stance is that they could potentially cut rates this year, whether they could raise rates this year, whether they're going to plan to just keep rates paused all year, what they plan to do, what the recession expectations are like, what the job market looks like, what inflation expectations look like. Again, these are all things that are important to understand and watch for this specific meeting. So I hope that makes sense. Where's NVIDIA at right now? All right, guys, 11 minutes. 11 minutes. Hey, hit that subscribe button if you haven't already. Hit the notification bell. I appreciate the love. Thanks so much. How is it flat though? It's expected. You know, a pause is what's expected by the Federal Reserve, chat. Like that is what's widely expected by the Federal Reserve, is a pause in rates. So I hope that makes sense. Again, this is what's expected, chat. This is what is expected by the Federal Reserve. Also, guys, if you haven't already, check out my sponsor. Check out Apex. Apex is a funded account program in futures. They give you a demo. Today, we did make some money on Apex. If we look at our Apex gains, we made like $400. Yesterday, we made over $1,000 in a funded account. If you want to day trade, again, I'm going to preface this with I always try to be honest and transparent about it. Most day traders lose money. If you put up $5,000 and it's your first day trading account, you're almost certainly going to lose that $5,000. I don't care who you follow, what course you take, who your mentor is, you're probably going to lose, right? And so it only makes sense if you're just getting started day trading to try the futures market out, because there's no PDT rule in futures. You can day trade the S&P and the NASDAQ, the SPY and Q price action. Patterns are very similar to blue chips, and to try a funded account program. Apex is one of the most legit. They've paid out over $100 million to their traders. They give you a demo and they test you with the demo. You still have to learn how to trade under pressure, and you're still risking something, but you're not risking the full extent of $5,000 or whatever your first account money would be. And it still teaches you how to day trade. And if you're good enough to pass it, the base one, they give you a 25K demo. If you can make $1,500 in profit without losing $1,500 first, they fund you $25K if you follow their rules. With a 90% split. So if you get funded, you're keeping 90% of your split anyway, and it just makes sense, right? It's limited risk, but still a 90% split once you're funded. Great way to learn how to day trade. Patterns are very similar to blue chip stocks. And again, they are a sponsor of mine. They pay me money. I'm biased, all right, because they pay me money. You also want to understand all these rules, CFTC 4.41, all that good stuff. But yeah, if you want to check out my sponsor, you can use coupon code BT. BT, 2 letters, BT. Get you the max discount at all times. Check it out. Again, there's the link in the chat right now. Understand CFTC 4.41 and all that good stuff. Here we go, guys. We got 9 minutes left. Really 8 minutes left, chat. You could also day trade gold. Yeah, I got a 50K account. Again, here is my stats today. Let me show you. All right, so market is very flat, waiting for Powell to speak. Again, we are ready here live. Be ready, chat. It's May 1st. All right, chat. Market's pretty flat here. All right, we are waiting here. We got the Fed's website up. We are live. on stream. We got the QQQ on the left. Oh yeah, let me show you my stats today. Again, so today we made 440. Waiting for it to give me my stats. It's just taking a little while. All right, guys. Waiting for the Fed meeting to start here. We got 6 minutes left, chat. 6 little baby minutes. Let's do this. Yeah, it's not letting me bring up my balance. Maybe. Remember, be careful trading right now, though. It happens every 6 weeks. So the Fed meeting happens every 6 weeks where they influence rates. It happens every 6 weeks. In between then, you have something called the FOMC minutes report. All right, let me switch my headphones out, actually. We got 5 minutes left, so let me switch my headphones out. All right, chat, 4 minutes. Yeah, Bitcoin has dropped a lot, down to 58,000. Is it time to buy the dip in Bitcoin, chat? I don't know. Let me know if you can hear the music right now. Might be a little low, but you should be able to hear it. Can you hear the music? You should be able to. I just want to make sure my headphones are working before the meeting. We got 4 minutes. All right, chat, here we go. Yes, you can hear the music. Can you hear the music, chat? Yeah, I'm in Meta right now. I didn't even realize Meta was doing so well. Look at the SPY spike here. Guys, SPY up to 423s. Meta spiking up as well. Can't hear? Okay, thank you, sir. I just want to make sure before the meeting starts. Oh, is the music too loud? My bad here, team. Let me turn it down. Sorry. I'm going to turn this music off pretty soon anyway. We got 3 minutes left, so yeah, I'm just going to cut the music off. I just wanted to make sure y'all could hear it. So... All right, yeah, we turned the music off. Look at the SPY. Q spiking up a little bit here. Again, Meta's up too. I'm almost green on the day in equities after a pretty red start to it. Again, Pfizer at 810s. Yeah. All right, chat. We got about 4,100 people live here watching. I get 2.5 minutes, chat. 2.5 minutes. All right, guys, y'all ready? Here we go. We got 2 minutes left. Whew. All right. Y'all ready? Again, will Powell be hawkish, bullish, dovish, bearish, tarantula-ish, octopus-ish? What do you guys think, chat? Let me know. Right now, squirrelish. any other animal-ish that I can think of. But seriously, do y'all think it'd be dovish or hawkish? I'm going to go with a hawkish Powell. I think inflation has looked a little bit too sticky recently. And to where that's kind of been a dangerous thing. Look at the Q spike up here. Here, let me put this up so where we don't have to worry about that. There we go. All right, guys, we got a minute and 10 seconds left. Hawkish. What color's Powell wearing today? I don't know. I'm green in equities. Green at last. We are at $11. All right, chat. Here we go. All right, guys. Waiting here. Technically, we got 20 seconds left. I'm going to mute the music in the background. Okay, and I'm going to unmute this music. And I'm going to click live to make sure we're fully live, which we are. All right. It's time. All right, let me know if the sound is good here. All right, here we go. Here's Powell. What color tie, chat? Let me know. Silence. As long as the environmental protesters aren't there lurking in the shadows waiting for Powell to pop out. I'm going to go with purple tie. Purple tie is what I'm going to go with, you know. Mix of green and red. So neutral, choppy, balanced. That's what I'm going to guess. Oh my gosh. Look at that. Wow. All right, here he is.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also we look at surveys of workers and, surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that, that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for...
Expectations are not anchored?
Or anchored.
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
I don't want to get into complicated hypotheticals, but I would say that, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
No rate cuts, basically.
Gina. Thanks for taking our questions, Chair Powell. I wonder, obviously, Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. Our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
Would that be like a reacceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%, and another path could be, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably that's what, or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also, even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we've said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity, we see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months' data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path than a 2% inflation. That's the signal that we're taking.
Steve.
Yeah, Mr. Chairman, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view, I think, that in fact we didn't gain confidence and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened. I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
No, I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to, to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Torres from Bloomberg. 2 questions. First, simple one. Given the run of data since March,
has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it'd be appropriate to cut until we were more confident that inflation was moving sustainably on 2%. We didn't get, our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's, the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them is further away from goal than the other, then you focus on that one. It's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation. And this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it, and that's how we think about that.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It would be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your question, your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. I mean, the question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year for that matter too. So I think in that case, I think you really do have a significant increase in potential output, but you've also got so you've got more supply, but those people also come in, they work, they have jobs, they spend, so you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive, and our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years, and that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3% to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
Yeah, I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly restrictive monetary policy needs more jobs.
Say September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. You know, it's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And, you know, we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And you know, we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. Nancy. Sorry.
Hey, Chair Powell, Nancy Marshall-Genzer from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck, and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at, anyway, headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes. I mean, I think that restrictive monetary policy is doing what it's supposed to do, but it's also, in this case, unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So you're right. I think that may happen. And you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably a significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not. It's not frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group around the table, frankly, more diverse than it used to be in many dimensions, more diverse from the obvious, gender and demographic ways. But also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question, though. Thank you very much.
All right, so that's Powell. My bad, guys. I don't know what's wrong with my internet. This is like the first time it's happened in like a year. So again, if you haven't already, stick around. I thought he was pretty dovish. Listen, honestly, I thought he was actually hawkish. I don't know why the market's reacting positively. If you guys know me, you know I'm like a huge bull in markets, right? Like I'm a big bullish trader. Like I'm an investor. And so like I want the markets to go up. I'm not shorting the healthiest companies in the world. That's dumb. I'm trying to long the healthiest companies in the world. With all that said though, what it seemed like to me is that the last FOMC meeting, Powell talked about how we were going to cut rates this year and that our base case is a rate cuts and all this different stuff. And then this meeting, he's saying he doesn't even know if we're going to cut rates this year, which would mean that from meeting to meeting, this was a more hawkish meeting, right? I don't know why. I guess maybe the market wants hawkish. The only thing I can consider is that, number one, slowing QT down, quantitative tightening, is a optimistic thing, is a positive thing for inflation, or not for inflation, I'm sorry, it's an optimistic thing for interest rates going down and consumer spending, right? Maybe that's what it is. It could also be that the Fed doesn't want, or that the public doesn't necessarily want Powell to cut rates, right? If the Fed, I personally didn't want him to cut rates. It's way too early. Inflation can spiral and snowball out of control. I don't necessarily want us to cut rates anytime soon. I thought him talking about a rate cut in June and July or wherever was way too early, and I think inflation isn't under control yet. And we've already had such big price spikes over the last 5 years. And prices very rarely go down. And so I don't know if we can really handle more inflation right now. I think we need to make sure we get it under control first before we start lowering interest rates back down. But again, the market reacted very positively to Powell here. And again, what I considered it kind of a hawkish Powell, and again, if you didn't think it was hawkish, let me know. It seemed pretty hawkish to me. I don't know anything that he said that was necessarily dovish, meaning he wants to bring interest rates back down anytime soon. And so again, sometimes the market doesn't make sense, and the market ended up ripping up on a more hawkish Powell, in my opinion. But hey, let me know what you guys think. Listen, if you want to check out our sponsors, we got two beautiful sponsors today. Number one, I'm biased because they pay me money. If they paid you money, you would be biased too. They pay me money, I'm biased, okay? The first one is Apex. Apex is a funded account program. If you want to day trade like I do, you can try a funded account program in futures. In the futures market, you don't need hundreds of thousands of dollars if you want to day trade. The PDT rule, if you want to day trade stocks, means you can't trade with under $25,000 in a margin account. You don't need to do that. You can trade futures. You can day trade the SPY price action. You can day trade the Q price action in the NASDAQ E-mini and the S&P E-mini. And there's no PDT rule in those futures contracts. You can buy market, sell market. Very similar to day trading stocks. You know, you can see this is very similar to day trading stocks. You can see about $440 today. Buy market, sell market. Open almost 24/7. Great way to learn how to day trade is these funded account programs where they give you a demo and they test your skill with a demo account first. If you pass the test, the base one, they give you a 25K demo. It's only $30 a month, or $30 for the first month. If you can pass that test, they fund you 25K with a 90% split. I think it might go up to like $50 a month afterwards, but regardless, it's pretty cheap month to month. And again, if you pass it, you get 25K in funding with a 90% split. You only got to make $1,500 in profit without losing $1,500 first. Again, a great way to learn how to day trade because your risk is limited. And to be fair, I think most day traders are going to lose here as well because most day traders lose. It doesn't matter where they go. It's a lot cheaper to lose an Apex account, and they've paid out over $100 million to their traders. Great way to learn trading, in my opinion, with limited risk. Instead of risking thousands and losing that, you can try this. Again, you can check out the link right there. Great way to help support the channel. The other sponsor I have is a company called Chart Prime. I'm not saying to use market orders. I'm saying you can buy market and sell market just like day trading stocks if you want. You can buy limit, sell limit, buy the bid, sell the ask, just like stocks is what I meant to say. I'm not telling you to use market orders, sir. I mean, I use market orders sometimes, but I digress back to the point. The other sponsor I have is a company called Chart Prime. If you do want to check out Apex, you can see the promo code BT, beginner trading, BT. 2 letters, BT will get you the max discount on Apex at all times. You can check out the link in the description. The other sponsor I have is a company called Chart Prime. It's a trading view service. You can use it in stocks, crypto, Forex, futures. You can use it with anything with a symbol on trading view, and it can just be powerful. Let me show you some of these indicators. Again, I always try to back test it live. I haven't looked at it since the FOMC meeting, but again, check it out. Again, we've had choppiness leading up to this. Like, look at their signals here. I can't guarantee you're going to make money. Nobody can. But like, look, this is a 5-minute chart. And so this is not like a 1-minute chart or anything like that. This one was probably wrong. But like, look at this one. Strong signal, beautiful breakdown. This is like from 4:30 in the morning all the way to freaking 10:30. So hours and hours and hours of red action afterwards. Buy signal here, same thing, from 10:30 all the way to 1:30 market time. Or 1:30 my time. Beautiful rip up. Strong signal there. Downward signal. Beautiful breakdown. Look at this strong buy signal here. Beautiful rip up. Again, I can't fake it. I can't guarantee you're going to make money either. Anything with a symbol on TradingView. There's so much stuff. You could use oscillators, back tests, or screeners. All this cool stuff. It's like $40 a month. It's just custom TradingView indicators, but they're really cool as well. Again, you can check them out. I'm biased because both of them pay me money. You know, I'm always honest and transparent about it. But if you want to check it out, here's the link. Great way to help support the channel. Also, guys, we're going to do a crypto show right now. Don't go anywhere. We're going to do a crypto show. We're going to talk about crypto. If you, for whatever reason, it doesn't bring you to the crypto show, as soon as we end the stream, it should bring you to the crypto show, number one. But if for whatever reason it doesn't, go to this link right here in chat. Here's the link right there in chat. Check it out. And again, as soon as we close this stream, it should automatically route you to the new stream. Chat, it should automatically bring you there. If it doesn't, again, there's the link in the description. I appreciate the love. Again, if you want to check out Apex, promo code BT, their sponsor. I'm biased. Check out Chart Prime. Links are in the description as well as in the chat right now. And yeah, we're going to go ahead and get this show started. Again, as soon as we close this stream, it should bring you there. Let me know what you guys thought about the Fed meeting. Bitcoin market has dumped. Crypto market has dumped a lot. And yeah, this will be interesting. All right, so I'm going to end the stream right now. Again, as soon as I hit close on this stream, it should bring you to the new stream. So don't go anywhere. I'll see you guys over there.